Welcome and good afternoon. I want to welcome you to today's presentation, Tax Matters and Tax Management Strategies. My name is Nathan Crampy. I am a certified financial planner and vice president here at Summit Investment Advisors, and I want to welcome you to kind of all of the ongoings and talking points of taxes. So as we get started here, we do have a little bit of kind of some housekeeping items that I want to go through with you. First of all, you have a toolbar associated with everything today, and you can minimize it and also maximize it just by pressing the red button kind of up in the corner there. Additionally, we will be talking more about any questions that you have at the end, but if you do have a specific question, please type it in our area here, and we will be able to not only answer them at the end, but we may even get to them kind of ongoing as the seminar is progressing. Lastly, I want to just say that you can find today's handouts in the section of your toolbar that says handouts. There are 4 handouts that you can look at there. So please go ahead and download those, and you can follow along on today's slides. Lastly, there's an evaluation at the end. Please go ahead and fill that in after today's evaluation. Excuse me, the workshop. I would like to introduce our speaker for today, Sean McDermott. Sean is a certified financial planner and the president here at Summit Investment Advisors. He has over 26 years of advising experience and does a lot with kind of looking at all the different avenues and aspects of taxes in association with the advising. So he is a very good resource to talk about all the different taxes and tax implications of financial planning. He is nationally recognized in Money Magazine, as well as the Minneapolis-St. Paul Business Journal, the Minneapolis-St. Paul Magazine, and please give a warm welcome to Sean McDermott. Sean.
Okay, good afternoon. Thank you for joining us. Benjamin Franklin said, "In this world, nothing can be said to be certain except death and taxes." So today we're going to talk about taxes and getting through another tax season. In the next 30 minutes, we're going to go through 3 goals. First, introduce you to how income taxes work. Second, to educate you on tax-favored investing and saving strategies. Thirdly, to illustrate tax planning opportunities. Taxes are a big part of life. The average federal refund check for 2014 was $2,792. Just under 110 million returns qualified for a federal tax refund in 2014. Put another way, the federal government wrote up checks for $306 billion to taxpayers. So more than likely, this is probably not going to be your strategy as to be paying in too much in taxes and waiting for a refund check every year. Instead, you'd rather have your money be invested in your retirement plans, your mutual funds, stocks, etc. So who pays income taxes in our country? The Brookings Institute for Tax Policy Center estimated that 43% of all households have no federal tax liability. So almost half of households do not pay federal income taxes. They also found the wealthiest 20% of taxpayers paid 84% of all taxes in our country. So who qualifies to get into the top 20%? Well, to qualify, your income needs to be about $111,000 per year, and it puts you in the top 20%. Now, on the other side of the equation, the bottom 80% of taxpayers only pay 16% of federal income taxes. And kind of the bottom of the bottom 20% of the 80% actually get money back every year in the form of tax credits from the federal government. So there's many different types of taxes that we face. There's federal tax, state tax, Medicare tax, Social Security tax, sales tax, property tax. There's taxes on tobacco, alcohol, schools, telephones, cable bills. Seems like every which way you turn, there's different types of taxes that we're paying. taken together, taxes can be a very large burden on our income on a year-by-year basis. I always love this quote from Dave Barry. He says, "It's tax time. I know this because I'm staring at documents that make no sense to me, no matter how many beers I drink." That always cracks me up, and I know everybody out there is on mute, but I can kind of hear you laughing. Now, the impact of taxes on our investments can be very expensive. In this study from Morningstar between 1926 and 2009, the after-tax return on stocks has been 7.7%. Now, if you're able to defer the taxes or have more tax-sensitive type investments, the return would have been closer to 10%. So obviously the government wants a pretty big slice of the pie on a year-by-year basis on your growth rates. And we think that the government is actually your highest expense when it comes to investing. And so we want to try to avoid the taxes. And of course, everybody's heard this before. Do you know the difference between tax avoidance and tax evasion? It's about 15 years in federal prison. So today we're going to talk about tax avoidance. Now, Will Rogers said the difference between death and taxes is that death doesn't get any worse whenever Congress goes into session. So as administrations come and go, the tax rules change. Basically, since 1940, there's been 80 major changes to tax legislation. And each time the tax rules change, you need to adjust your ways that you're investing, adjust ways that you're taking your investment income. And so we want to stay current with the tax laws, and that'll definitely help you keep your tax liabilities down. We're going to jump right into here and talk about how income taxes work. Now, basic formula for this, and we'll dive more into it, is we start with our gross income and we subtract out our adjustments to come to our adjusted gross income. From there, we're going to have deductions and exemptions to come up with our taxable income. Now, I'm going to jump ahead, and this is actually a federal tax return. And I'm going to zoom in on this area here that starts off with where we begin our return, and that's with our income. And so you can see that income line items would be wages, salaries, tips. Oftentimes this is going to show up as your W-2 income. And then you'll also likely receive 1099s each year. And on here you'll find your taxable interest, tax-exempt interest. You'll have dividends, ordinary dividends, qualified dividends coming in. Some folks out there might have alimony or business income coming in if they're possibly running S-Corp or maybe doing some consulting. There's going to be capital gains that you have to account for or losses. For retirees, oftentimes they're taking IRA distributions, and you'd add those up along with your pension and annuity income. Some folks out there have rental real estate or possibly farm income coming in, and that's going to be on lines 17 and 18. Unemployment compensation. And then line 20, 20A is actually your Social Security benefits. A lot of people don't realize this, but their Social Security benefits can be taxable depending upon if your provisional income goes over certain thresholds, which we're going to talk about later. Now, combine all these together, and that will that's where you get your total income from on line 22. From there, you'll have some adjustments to your income. So there could be things like health savings account, moving expenses. A very common one would be IRA deductions. Maybe there's student loan interest or tuition and fees. So these are the items that you add up to get to the bottom line on your Form 1040, line 37. That's going to be your adjusted gross income. Moving on to the second page of our tax return, you'll then go to line 40 and you'll find your itemized deductions. So your itemized deductions can include home mortgage interest paid, property taxes paid, could be charitable contributions, state income taxes paid. These are some of the more common itemized deductions. Now, if you add those up and they don't amount to what is greater than the standard deduction, then you'll just fill in the standard deduction. So a lot of retirees, once their mortgage interest is paid down or their mortgage is paid off, and they don't have as much state income taxes through their wages that they're paying, oftentimes they're going to end up just using a standard deduction. Now, from there, you'd subtract your exemptions. The exemptions for the tax year 2015 are $4,000 per person. And then once you subtract your itemized deductions and your exemptions, line 43 would illustrate your taxable income. And so I'd like you to make a note that line 43 is something that on a year-by-year basis you want to know and pay attention to, because this is going to drive what federal income tax bracket you fall into. And the federal income tax bracket that you fall into will determine what your capital gain tax rate is going to be, what your dividend tax rate is going to be, and many other things. So when you get home, or if you have a chance, look at line 43 of your tax return, because it says a lot about what bracket you're in. There are some other tax credits that sometimes you might be able to reduce your taxable income. And then we have other taxes. And then when you get through line 64 through 74, you can figure out, okay, well, here's what I've already paid in this year. And then if you've paid in enough as to more than you owe, then you're going to be due a refund. But then sometimes you might be doing your tax return and you're going to owe a little bit of money in, or whatever it amounts to. So those are kind of the basics when it comes to filing a tax return. So we start with our gross income once again. And after we tally up our income, we subtract out our adjustments to come from our adjusted gross income, and that's the bottom line of the front page of your tax return. We have our deductions, and then we have our exemptions. That brings us to our taxable income. So the marginal tax brackets, as you can see in the slide here, can range from anything from 10% to 39.6%. And as you'll see here, for single individual taxpayers, if your income is below $9,225, then it's taxed at 10%, and you can have all the way up to $37,450 of taxable income and still be in a 15% bracket. But once you go over that $37,450 line, then your tax bracket moves up to 25%. You'll see for married filing jointly, to be in a 10 or 15% tax bracket, your income needs to be below the $74,900 threshold. That's taxable income needs to be below that. Now, why these brackets are important to understand is that it really helps to know where you're at when it comes to retirement, or if you need monies out of your portfolio. So I'll give you an example. I recently met with a client, retired client, and they have $30,000 of pension income coming in and an additional $30,000 of Social Security income coming in. So we ran some tax calculations and found out that their adjusted gross income would be $45,000. And from there, we subtracted out their 2 personal exemptions and a standard deduction, and those amounted to about $20,000. So we figured, okay, this couple has $25,000 of taxable income, and if you look at the tax chart, you can see that they are definitely in a 15% bracket. They're not above that $74,900 level. Now, once we knew their rate of tax, then we could start to figure out, oh, what is the best investment to draw income out of to supplement their pension and Social Security. And in their case, what we wanted to do is draw money from their IRA and 401k accounts because it really didn't have a huge tax liability at this point in time. So it's always good, on a year-by-year basis to rerun the numbers, figure out, okay, what's the best place to draw income from? Or on the other side of it, if you're not already retired, if you're in these higher brackets, it will give you an idea of what your tax savings is if you put money away on a pre-tax basis. 2016 marginal tax brackets, the numbers went up slightly. And we did include in the handouts, if you want to download the handouts that are available through the webinar, or if you want to email to us, we did put in the 2016 annual limits for how much you can contribute to 401ks, etc. Here, let me zoom in on the slide here. So you'll see 2016, if you're contributing to a 401k, 403b, or pre-tax retirement plan, you can put in $18,000. And if you're over age 50, you can add an additional $6,000. So it's $24,000 pre-tax is the maximum for the year 2016. There are some other numbers there for IRA contributions, $5,500 plus an additional $1,000 catch-up. And then you can see the Roth IRA contribution limits. And again, if you're not adding to a Roth IRA right now, Roth IRAs are a great tax advantage because they do compound on a tax-free basis as long as you're leaving the money there for at least 5 years and age 59 and a half. Some other interesting things for 2016, the Social Security wage base is at $118,500. What this means is that if all the money you earn from wages, $118,000 or up to $118,500, you're going to pay Social Security tax on, and the rate is 7.65%. Once you're over the $118,500, you don't pay the Social Security tax; you just pay Medicare tax. Other areas of interest on this chart, you'll see estate and gift tax exclusion amount. You can actually pass on $5,450,000 on a federal level without any estate tax, and then you can gift up to $14,000 per year. There's some other interesting information on there if you're on Medicare and what the premium rates are. I'm going to go to the next page here. And here, we'll zoom in, you can see the tax brackets for 2016. You can see the personal exemption amount for 2016 has gone up by $50, whoopie-doo, instead of $4,000. And then the deductions are now $12,600 instead of $12,400. So obviously they're not going up very quickly. Okay. So with that, I'm going to keep moving here because we have a lot of ground to cover. Now there are some phase outs of personal exemptions, and what this means is if your income is for a single individual over $259,000, and for married filing jointly, if your income is over $311,000, then you're not going to be able to take all of your personal exemptions. This slide here, I think, is pretty critical. What we're referring to here is capital gains and dividend distributions. So for any investment that you make, like in stocks or mutual funds, if you buy the investment and sell it within the first 12 months, it's going to be taxed as ordinary income if there's a gain. Now, if you hold it for more than 12 months, the tax rate qualifies for capital gain tax treatment. The capital gain tax treatment is a little different than ordinary income tax. So let me give you an example. Going back to those tax brackets, which we referred to earlier, if you are in a 10 or a 15% bracket, then your capital gain tax is at a 0% rate. I'll repeat that. If you're in a 10 or 15% bracket, your federal capital gain tax rate is 0%, all the way up to the line where it says, okay, $74,500. Once you go beyond that into the 25% bracket, then the capital gain tax goes to 15%. Same thing for the dividend tax. Excuse me. The dividend tax rate is also at 0% or 15%. It's very rare that we see individuals that are paying a 20% tax rate. You'd have to actually fall into the 39.6% federal tax bracket before you'd be subject to the 20% tax rate. So knowing your tax rate in this area, again, is important, especially if you own employer stock. And what we want to try to do is take those capital gains when you can in a lower bracket, because then you don't have to pay the federal income tax. The state of Minnesota tax is always there unless you decide to move to a state that's exempt from taxes like Florida or Texas. We've seen a few clients do that at retirement in order to avoid taxes on their capital gains. The other side of this coin is if you have capital losses in a year. So in 2015, the stock market went down, and it's not off to a very good start in 2016 either. And so there are times that if you have an investment that goes down in value, you could actually sell that investment and go into a similar investment, not the same investment. And on your tax return, you're actually realizing a capital loss. So example, if let's say that your investment goes down by $10,000, you could sell the investment, repurchase a similar investment. So if let's say it's Medtronic stock, you could sell Medtronic stock and repurchase another stock like 3M stock. So if the stock market starts going back up, you're going to ride the market back up. But on your tax return now, you have a $10,000 realized loss that can be used to offset future capital gains, or you can use that realized loss to offset up to $3,000 of ordinary income each tax year. So again, pay attention to investments that go down in value, because you might as well take advantage of that, because it's almost like a 30 to 35% tax break from the government if you're realizing those losses. And so we call it making lemonade out of lemons. Now, this is kind of interesting when you retire and you start to draw your Social Security benefits. Oftentimes this comes as a little bit of a surprise, but taxpayers might be, like I have a client that came in and they're getting a couple $1,000s per month in Social Security income, and they went to do their income taxes and they found out that 85% of their Social Security checks were going to be taxed at a 15% tax rate. And so they're just like, oh, well, we didn't know we had to pay income tax on Social Security. So they're basically ending up paying about $500 a month of taxes on their Social Security benefits, state and federal taxes, and they had to catch up with those at the end of the year. So what you'll want to do here is make sure you're running through the tax equation. It's called provisional income. If your provisional income exceeds these thresholds that you can see on this chart, then you're going to owe tax on your Social Security benefits. What does your tax return say about you? So you can analyze your 1040 return that we talked about. You can figure out what bracket you fall into. You can figure out if you are able to itemize or just take a standard deduction. And then you can also identify in Schedule B, you can say, okay, yeah, I'm receiving dividends, and the dividends are being taxed as ordinary income. So maybe I want to have my dividends be taxed as qualified dividends and change the type of funds that I'm owning. Or there might be times that you go, okay, geez, I have a lot in dividends and interest that are being paid out. I should try to make this tax deferred and put it into a Roth IRA or maybe a tax deferred annuity or something where you're not getting beat up every year in taxes. Love this quote from Jay Leno. He said, worry about an IRS audit, avoid what's called a red flag. That's something the IRS will always look for. For example, say you have some money left in your bank account after paying taxes. That's a red flag. Let's talk a little bit about tax-favored investing and saving strategies. Now I'm going to go quickly through these examples because we've had several webinars and workshops here at our office that deal with how to invest on a tax-favored basis. And we do have a workshop this afternoon which will be held at 4:30 p.m. that you're welcome to attend if you want to get more into details. We're going to spend more time talking about tax-favored investment strategies. That's at a workshop here at Summit Investments right in Roseville. But there's basically two types. There's tax-exempt investments. Those would be like your municipal bonds, money market funds, and there's tax-deferred investments, which could be 401ks, IRAs, Roth IRAs, annuities, life insurance. Municipal bond market is a popular way of investing into interest-bearing security. It's fairly large. And municipal bonds, there's individual bonds, and there's mutual funds that you can purchase, and munis. Reasons why you'd want to own municipal bonds in the portfolio is because the interest you earn on them is actually tax exempt from federal taxes and sometimes tax exempt from federal and state taxes as long as the bonds are held here or in the state that you own them. So in this chart here, if you're earning, let's say you're earning 3% return on your municipal bonds, and if you're in a 33% marginal tax bracket, that's like earning 4.5% taxable, and so that's where we get our tax equivalent yield charts. Now, you've heard this many times before that it's really important to invest pre-tax, because if you're not putting it away pre-tax, it takes a lot more income in order to have the same amount invested. So in this example, we say, okay, if you're investing $1,000 a year pre-tax, you guys would have to earn $1,389 on a taxable investment, or in order to put away $1,000 into a taxable investment. Now I'm going to keep moving fairly quickly here, and you guys can review the slides offline. There's tax-deferred investments, and again, you know, the argument here is that the more money you defer, the more money that you're going to have down the road. And the nest egg, in this example, you can see has quite a bit more money in it, and that's what the name of the game is build up those nest eggs as big as possible for your future retirement. Tax planning opportunities, there's different things that you could do with stocks and property in order to avoid income taxes. Those are what we call stock and bond swaps and 1035 exchanges. There's U.S. Treasury securities that are free from state of Minnesota taxes. And then, of course, if you're looking for itemized deductions, you can do charitable contributions. And year by year, when you are doing your tax return, especially for people that are age 70 and a half, where they're having to take required minimum distributions, you can actually have your required minimum distribution go directly to a charitable organization, and it won't show up on your federal tax return. So this works quite well for individuals that want to try to keep their Social Security tax to a minimum and want to keep their brackets to a minimum, where they'll actually gift their RMDs directly to charity instead of taking it into their own account. Let's the homeowners slide here. A couple of notes I'll just make here is that there are some deductions for if you're refinancing or purchasing a home that you'll want to talk to your accountant about. If you're selling a home, then for a single individual, you can take up to $250,000 of gain without taxes, and then for married, filing jointly up to $500,000 tax-free. And you can do this, you just have to live in the property for 3 years. I think it's 3 of the last 5 years. For individuals that might have farm property or business property, there's a thing called a 1035 exchange, and how this works is you can take that appreciated property and exchange it for another like-kind property and avoid the capital gain tax on it. So we've seen this being done on a couple of occasions over the last few years, especially with highly appreciated farmland. What if you get audited? If you get audited, my first recommendation would be make sure you're talking with a qualified tax professional, like a certified public accountant, and because you want to be real careful here, because you might divulge information that the IRS isn't even looking for. The state of Minnesota has been doing quite a few audits recently. I heard they hired right around 300 new state auditors, and so the number of individuals that are being audited is way up compared to what it was a few years ago. And so again, it's probably a good idea to hire somebody at a point if you are going through an audit process, just so you don't end up getting yourself in more trouble than you might already be in. Where do you go from here? If you're doing your own income tax returns, feel free to use us as a sounding board. We're always here to help with tax questions. We do have a tax professional on staff, Eric Budd, and Eric has quite a few years experience preparing income taxes. And we also have a couple of CPAs in the area that we recommend for helping with calculating capital gain taxes on employee stock purchase plans, and for business taxes and so forth. So feel free to ask us anytime if you need a tax professional to help prepare your taxes. And then whenever we meet with our clients, we always like to have them bring their tax return along, so then we can know what bracket they're in, which investments are most suitable for their tax situation, whether they should go pre-tax or tax or use Roth IRAs, what accounts to draw it out of, and so forth. So it's a big part of our job is to figure out, how to minimize taxes and minimize the government taking, 25, 35% of your account. I'll finish with this quote. Dave Barry said, "And to you taxpayers out there, file your tax return on time. And remember that even though income taxes are a pain in the neck, the folks at the IRS are regular people just like you, except they can destroy your life." So with that said, here's our contact information. Remember, you can download the slides that are available in the handouts, and I do have handouts on how income taxes work, understanding federal income taxes, the tax brackets, and so forth. So check those out. And again, our next webinar coming up in February, on February 16th, we have a special guest speaker. It's the former CEO of Medtronic Corporation, Bill George, and Bill is going to be talking about his book, Discovering Your True North. Very intelligent man. He's a Harvard professor, sits on the board of directors of many large Fortune 500 companies, and so if you're in for a real treat if you tune in next month on February 16th. So with that, we're going to wrap it up, and please fill in the survey and any comments that you might have for us, and once again, we're here for you if you need any help with your tax preparation. Thank you.